has changed the outlook of global banking system to stable from negative. So overall, I think we are seeing improving trend across the world in most regions, including North America, Europe, and Asia Pacific, excluding China. And next year, we are likely to see a more stable operating environment, kind of stable asset quality, capital, and funding liquidity for banks. And the key driver that you mentioned, right? The first driver is the slower but kind of stabilized economic growth. And second key driver is the monetary policy easing. If the inflation trends down as expected, we are expecting most central banks in the world to cut their policy rates, which will be positive for banks.
Why are you ex-China on this? Why are Chinese banks still on negative outlook? Because I understand while there might be pressure on NIMs because of what's happening on the ground with monetary policy action or inaction, these are well-capitalized banks, and I've seen some of, at least the big four in China, rally away. I mean, you look at their equity prices, they've gained anywhere between 20 to 30% from a year-to-date perspective, all of 2024. So what makes you circumspect about the health of the Chinese banks?
Yeah, so, I mean, despite we changed the outlook of other regions, right, to stable from negative, we keep the negative outlook on Chinese banks unchanged because of the concerns on the persistent pressure on their profitability. And another reason is the negative on China's sovereign rating, which may kind of, weaken Chinese government's capability to provide support if needed. So as I mentioned, right, we have seen some positive developments since September this year, which drive the rally of the stock prices. The stimulus packages announced by the governments, I think, will kind of improve the operating environment for Chinese banks. And also, we are expecting Chinese banks to report stable NPL ratios, non-performing loan ratios, with the regulatory forbearance and the easing stance of monetary policy. But having said that, as you pointed out, I think Chinese banks will face continued pressure on their net interest margin over a long period of lower for longer interest rate environment. So with the policy rate trends down, likely Chinese banks' loan yield will continue to go down. But on the other side, because of the very intense competition for deposit, we think Chinese banks will not be able to quickly lower their deposit cost. So the NIM will be kind of under consistent pressure. In the past 3 years, we have seen the NIM kind of narrowed for over 50 BPs. And this trend will continue and will negatively affect their profitability.
Interesting, because that is something that I think the PBOC has flagged, that we could potentially see further deposit rates cut to try to offset that. But you don't believe that will do the job, no doubt, because some of these banks are facing, as you say, pressure on NIMs, but no doubt also caught between a rock and a hard place of having to support the cash-strapped developers while also trying to protect their own asset quality.
Yeah, exactly. So, I think there's asset quality pressure, right, for sure. I mean, they have exposure to property developers, even though the size is not that big. And also they have material exposure to local government financing vehicles, right? So I think the government stimulus package will help, but at the same time, banks need to lower their loan pricing on these kind of local government financing vehicle loans to support their debt repayment capability, right? This will affect the asset yield, right? At the same time, as I mentioned, right, it's very difficult to lower their funding cost. So overall, I think banks need to kind of sacrifice their profitability to support economic growth.